guys, in the last two examples, we looked at how you should calculate either the market value or cost of debt for redeemable debentures. Let's see how that calculation changes when you are dealing with a loan that requires repayment. Daenerys Limited obtained a loan from Eden Bank SA on the 1st of January 20X3 for an original amount of R1 million. The interest rate on the loan is 1% above the current market-related rate of 8%. All right, so if the current market-related rate is 8%, that is going to be your cost of debt, which you are going to use as your discount rate when calculating the market value. Then the interest rate on the loan is 1% above the market-related rate. So the interest rate on the loan is going to be 9%, and that is the coupon rate which we are going to use to calculate our interest cash flows. The loan capital and interest are repayable in a single bullet payment on the 31st of December 20X7. The loan qualifies as an instrument and is deductible for tax purposes in terms of Section 24J of the Income Tax Act, and you need to calculate the market value of the loan at the 31st of December 20X4. All right, so why is this example important? Well, firstly, you have been given the cost of debt. So the cost of debt over here has been given, and you are required to calculate the market value of the loan. In addition to that, this example shows you how to deal with a situation where the interest and capital on the loan is repayable in a single bullet payment. And this example also shows you how to deal with Section 24J of the Income Tax Act. And please note, if the question is silent, you should assume that Section 24J is applicable. So even if you weren't told that the loan qualifies as an instrument and is deductible for tax purposes in terms of Section 24J, you can assume that it is deductible in terms of Section 24J. All right. Now, guys, when you are dealing with a loan, I want you to break your calculation down into two steps. In step 1, we are going to calculate our cash flows, and then in step 2, we are going to actually answer the required by calculating the market value. Now, why am I breaking this calculation down into two steps? Why do you first need to calculate your cash flows before actually answering the required and calculating the market value? If you go back to the previous example, where we were looking at redeemable debentures, in this example, you were also given the cost of debt and you had to calculate the market value, but I didn't break your calculation down into two steps. We went straight into the calculation where we calculated the market value of the redeemable debenture. You didn't first have to calculate the cash flows. So why now is the example with the loan different? Please note, guys, the only reason why this wasn't broken down into two steps is when you are dealing with redeemable debentures, it's very easy to calculate your cash flows. So it wasn't required, or a separate step wasn't required for this calculation. Here we can easily calculate our interest cash flow. We also calculated the redemption amount over there. They were very simple calculations, and we could then combine the two steps, easily calculate what all of our cash flows are, input everything onto our table, and calculate our market value. So it was much easier when dealing with a redeemable debenture. With a loan, it's a little bit more complicated when it comes to calculating your cash flows, and that's why I've set this out rather in two steps. First, we're going to make sure we actually get our cash flows, and then we'll answer the required. So please note, before we can calculate the market value, you need to know what your cash flows are. We applied the same logic to all other sections. The cash flows were just easier to calculate and didn't require a separate step. All right, so please make sure you understand the logic here. There's no rules in management accounting. Everything follows a logical approach. Make sure you understand the logic. Before you can calculate your market value, you need to know your cash flows. And why do you need to know your cash flows? Because guys, your market value is just the present value of your future cash flows. So we look at all of our future cash flows, we present value those, and that gives us our market value. So you obviously can't calculate your market value if you don't know what your cash flows are. So first, let's determine what our cash flows are. So the company entered into a loan agreement with their bank on the 1st of January 20X3 for an original amount of 1 million rand. So the present value over here in your calculation is going to be 1 million rand on the 1st of January 20X3. Then please note we are trying to calculate our cash flows, so you don't use the cost of debt. When you are trying to calculate your cash flows, we use our coupon rate to calculate our interest cash flow. So your interest rate over here is 9%. Then please note this is extremely important. In step 1 of your calculation, you should ignore tax and transaction costs. So I'm using the interest rate over here before tax. I'm not multiplying by 72% to get the after-tax rate. All of your calculations in step 1 are before tax. Then, the company enters into this loan agreement on the 1st of January 20X3, and everything is repayable in a single bullet payment on the 31st of December 20X7. So guys, the full period of the loan is 5 years. Please note in step 2, when we are calculating the market value, we are only going to look at future cash flows. However, in step 1, when we are calculating our cash flows, you look at the full loan term. So the full loan term is 5 years. You include that in your calculation over here. Your payment is 0 because nothing is paid during the loan period. All interest and capital is repayable in a single bullet payment on the 31st of December 20X7. So payment is 0 and you compute your future value. All right, guys, and you can test that n must equal 5 because the present value of the loan, or when you first entered into the loan, it was the 1st of January 20X3, and it's repaid 5 years later on the 31st of December 20X7. So that is why n is 5. Look at the full loan term. Now we said the whole purpose of step 1 was to calculate our cash flows. After we know our cash flows, we can then move on to step 2 and calculate our market value. We now know what our cash flows are. When the company first entered into the loan agreement, they would have had a cash inflow of 1 million rand, and on the 31st of December 20X7, they're going to have a cash outflow of 1,538,624. Those are our cash flows. Now that we know what our cash flows are, we can calculate our market value. However, please remember dates are very important in these questions. You are required to calculate the market value at the 31st of December 20X4. So our first column is 31 December 20X4. We then have 31 December 20X5, 20X6, and the loan is repaid on the 31st of December 20X7. Only look at future cash flows in your calculation. So what are our future cash flows? On the 31st of December 20X7, we have an outflow of 1,538,624. So show your cash flow over there. All right, guys, now we just need to take tax into account. And please make sure that you always show the tax rate that you are using in the question. There's a consequential mark available for showing the tax rate, so make sure that you clearly show what tax rate you are using. Now, when it comes to our tax calculation, guys, we need to incorporate Section 24J of the Income Tax Act in this calculation. Now, most people really overcomplicate this calculation. It's actually a very simple calculation. If you go back to step 1, you already have all of this information over here in your financial calculator. Keep that information in your financial calculator. Then, using the amortization function on your financial calculator, I need you to pull out the interest for periods 3, 4, and 5. Why am I only looking at the interest for period 3, 4, and 5? We know that the full loan term is 5 years. However, 2 years have already passed. So we are looking at our future cash flows in this calculation. And the years remaining on this loan are years 3, 4, and 5. So that's the interest that we are looking for. We are looking for the interest in year 3, year 4, and year 5. So you can ignore year 1 and 2 because those are past cash flows. So using the amortization function on your financial calculator, get the interest. Now please note, guys, this is the interest that accrues over the loan period. In this example, all of the interest is only repaid right at the end of the loan term. The interest and the capital is all paid right at the end of the loan term. So the cash flow takes place on the 31st of December 20X7. But how Section 24J works is you get, or the company gets, the tax deduction for the interest as it accrues over the period. So we are not interested in the interest cash flow. My interest cash flow takes place on the 31st of December 20X7. I'm interested in the interest that accrues over the loan period. So using the amortization function on your financial calculator, get the interest that accrues in period 3, 4, and 5. Now guys, as an alternative, if you don't want to use your financial calculator, you can draw up this amortization table that I've included below, and you can get your accrued interest from this calculation instead. However, I don't recommend drawing up the amortization table. You won't have enough time. It's not worth it drawing up all of this. In addition to that, guys, if it's a loan with a very long term, it's going to take you a lot of time to draw this up. Please, you have your financial calculator, use your financial calculator. Don't waste time actually drawing up the amortization table. The reason why I've included this in your lecture notes is more for your logic and your understanding. I don't just want you doing something on the financial calculator without actually understanding what you're doing. So use your financial calculator, but make sure that you understand where those amounts are actually coming from. And this is where the logic comes from your amortization table. Right, but please don't waste time actually doing that. Then what you are going to do is you take the accrued interest for periods 3, 4, and 5, you multiply by your tax rate, because remember guys, interest is tax deductible. The company is going to get a tax deduction for interest. So this interest amount over here in terms of Section 24J is tax deductible. Multiply it by 28% so that you can get your tax saving. And then you input that tax saving into your calculation above. So please note, this is a tax saving. The company gets a tax deduction for interest, so it reduces the amount that they need to pay across to SARS. It's a saving, so we show it as an inflow. All right, so how does Section 24J work? We are not interested when the actual cash flow takes place. We are interested in when the interest accrues. So the company gets their tax deduction as the interest accrues, not when it is actually paid. The interest is only paid on the 31st of December 20X7. We don't get the tax benefit when we actually pay the interest. We get the tax benefit as the interest accrues over the period. So that is the logic behind Section 24J. Very simple, not too difficult. Then please note, guys, it's not necessary to show all of these calculations over here, because I've showed you how to calculate that tax saving just below, so you don't have to worry about showing those calculations. However, please note, you mustn't just use your financial calculator and then write down the answer from your financial calculator. You must actually show this calculation, otherwise you are going to lose out on those marks. So you must actually show the calculation. Don't just do everything on your calculator. All right, guys, so we've taken our cash flow into account. We've taken tax into account. We can then total our cash flows Input all of these cash flows into your financial calculator. You guys can see that your annual cash flows are not equal. So in this example, the shortcut method can't be used because your annual cash flows are not equal. They're different every year, so we have to use the cash flow function on the financial calculator. And then remember, we use the cost of debt as our discount rate when calculating the market value. And in this example, you've been told that the cost of debt is 8%. You were not told if the rate is before or after tax. Guys, if the question is silent, you assume that it's before tax. So we need to take that rate of 8% and multiply it by 72% to get the after-tax cost of debt. So your cash flows above are after tax because you've taken this tax benefit into account. Your cost of debt is also after tax. You input all of your cash flows and you calculate your market value. So we are just present valuing all of our future cash flows in order to calculate the market value of the loan. All right, guys, so don't overcomplicate this calculation. It's a simple calculation. First, get all of your cash flows. You need your cash flows before you can calculate the market value, so get your cash flows. Keep this information in your calculator because you're going to use the amortization function in your calculator. Then once you know what your cash flows are, put your cash flows onto the table. Make sure you are only looking at future cash flows in your calculation over here. Using the amortization function on your financial calculator, get the accrued interest, multiply that by 28% to get your tax saving in each of these years. Total your cash flows, use the cost of debt as your discount rate, and calculate your market value. Very simple. Just make sure that you show all of your calculations, make sure that you show your tax rate so that you don't miss out on easy marks. Now guys, in the next example, you've just been told to ignore section 24J. So all of the information is the same as the previous example, but how will your calculation change if you are specifically told to ignore the impact of section 24J of the Income Tax Act? Now we said with section 24J, the company gets the tax deduction for interest as the interest accrues over the period. The only difference now if you are told to ignore section 24J is you are going to get the tax deduction for the interest when it is actually paid. So if it's section 24J, you get the tax deduction as the interest accrues. If you are told to ignore section 24J, you get the tax deduction when the interest is actually paid. So step one of your calculation is exactly the same where you are calculating your cash flows. There's no difference over there. Then in step two, when we are calculating the market value, please note all of the interest is paid on the 31st of December 20x7. So take the interest amount. Guys, the capital amount is 1 million rand. So the balance is obviously the interest portion. The 538,624 is your interest. Multiply that by 28% to get your tax saving. So you can see the company doesn't get the tax deduction for interest as it accrues over the period. The interest is only paid on the 31st of December 20x7. So when the interest is actually paid, the company gets this tax deduction or the tax saving. And now in this example, because your annual cash flows are equal, there are no annual cash flows, your payment is 0, you can also use the shortcut in this example. All right, but that's the only thing that changes. Please work through that, make sure that you're happy with that. In the next example, the reason why this example is important is it shows you how to perform the calculation if the loan is repayable in equal annual installments comprising of capital and interest. In our example, the full loan amount was repayable in a single bullet payment at the end of the loan term. In this example, everything is repayable in equal annual installments. So guys, if you struggle with time value of money calculations where you are required to calculate your cash flows, you must please work through this example. Then in this example, the loan is repayable in biannual equal installments. So instead of just having payments once a year, interest and capital payments once a year, you now have interest and capital payments twice a year. So once again, if you struggle with time value of money, then you must also work through this example. All right, guys, so that deals with redeemable debt. Let's then look at convertible debt. So with convertible debt, the company is going to issue debentures in order to raise finance. So investors will buy the debentures, and that will result in a cash inflow for the company. Then over the period, interest is going to be paid at regular intervals, and that is obviously going to be a cash outflow. And at some point in the future, the debentures are going to convert either at the option of the company or the investor. And we show that as a cash outflow in our calculations. Now guys, you should approach this calculation in exactly the same way as we approached the calculation for convertible preference shares. You'll remember I broke the calculation down into 2 steps. And I told you in step 1, we are going to calculate the future value of each alternative. And after you've calculated the future value of each alternative, you need to decide what's going to happen. And that depends on whether the debentures are going to convert at the option of the company or the investor. If they are going to convert at the option of the company is obviously going to select the alternative with the lowest cost because that's what's most beneficial for them. That's the cheapest option. However, if they are convertible at the option of the investor, the best option for the investor would be to select the alternative with the highest value, so you then select the alternative with the highest value. Then, after that, you can calculate either the market value or the cost of debt depending on what is actually required. Now guys, this follows exactly the same logic as convertible preference shares. There's only one extra thing that you need to remember when dealing with debt. Because interest is tax deductible, your interest cash flow and the cost of debt must be after tax. But apart from that, your calculation is exactly the same. So please work through the lecture example and make sure you are happy with the calculation of convertible debt.